Planning to start a YouTube agency? You might want to think twice. Not because you shouldn't do it, it's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. There's a pattern showing up across the creator economy right now. Businesses build entirely inside other businesses. Someone doesn't build a channel, they build the company that helps other people build channels. One of the clearest examples of this pattern, done at real scale, involves a name almost everyone recognizes. Kaby Lame, the most followed creator on TikTok, didn't just become famous. He eventually built an agency of his own, one that now supports 235 other creators. Here's the part almost nobody's talking about yet. In the last 2 weeks, as this video was being finished, a company tied to his business went from under $6 million in prior year revenue to a stock market valuation over $16 billion, and lost most of that again just as fast. We're going to come back to his story in full detail, because it's more complicated and more current than most people realize. But his story is the well-lit version of something that's exploded far beyond it. Thousands of much smaller operations now sell some version of the same pitch. Let us build, manage, or grow your channel, and you keep making the videos while we handle the rest. Some of these are legitimate businesses doing real work. Some are something closer to reselling a dream that never quite delivers. Almost none of them look different from the outside. Before we go further, it's worth being precise about what we're even talking about, because this space covers a few different businesses wearing the same name. Talent management is the oldest version, representing a creator who's already succeeding, negotiating brand deals, taking a commission. That's closer to a traditional talent agency, just built for the internet. Multi-channel networks, or MCNs, were a specific, mostly historical structure from the early 2000s, aggregating thousands of channels for better ad rates. We'll get into what happened to that model because it's a useful preview of where this newer version could head. And then there's the newer, more controversial category this video is really about. Agencies that build and run channels for clients from scratch, often marketed with the exact same make money without showing your face pitch that's built entire businesses just like this one. Which brings us to something worth saying directly instead of avoiding. This channel uses some of the same tools and the same general growth playbook that some of these agencies package and sell as a service. We're not outside this story looking in. We're close enough to it that we have real reasons to want to get it right. So what actually separates a legitimate version of this business from a predatory one? And how would you even tell the difference before you'd already paid someone? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is real, sourced, and independently checked. But costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific address. A second note, specific to this episode. Everything you're about to hear describes business models and industry-wide patterns, not any single company. Where we reference a specific business by name, it's either a matter of completed public record, like a regulatory action, or a positive, well-documented example. This video isn't legal or financial advice. If you're evaluating a specific agency, that due diligence is yours to do. The first cost, the one that barely exists on the agency's side and varies wildly on the client's, this might be the lowest capital business on this entire channel to start, which is precisely why so many people start one without a real plan underneath it. Almost nobody starts one of these agencies with outside investment or a business loan. The typical path is one of two doors. Door 1. Someone grows their own channel to real success, then packages what they learned into a service for other creators. Door 2. Someone starts as a freelance video editor or thumbnail designer, picks up enough clients to see the pattern across all of them, and repositions from a single service into full channel management. Either path can start with essentially no capital beyond a laptop and existing editing software. That's the appeal, And it's also exactly why the barrier to calling yourself an agency is so low. On the client side, the real money starts moving. Basic channel management commonly runs $250 to $1,500 a month, covering upload scheduling, basic optimization, and light reporting. Mid-tier packages run $1,500 to $3,000 a month, typically adding strategy calls and more detailed analytics. Full-service agencies, handling strategy, production, and paid promotion together, commonly run $4,000 to $12,000 a month, with some full-stack operations charging $10,000 to $50,000 or more for larger accounts. Paid ad management specifically tends to run 10 to 20% of ad spend, or a flat monthly fee, whichever is higher. Per video production alone runs $1,500 to $10,000 a video, depending on production value. Notice how wide that range is. That's not a coincidence. This is a young, largely unregulated market with no standardized pricing, no licensing requirement, and no consistent definition of what full service even means from one agency to the next. Part of that wide range comes from what's being sold splitting into three distinct buckets. Organic channel growth, meaning strategy, scripting, and optimization. Paid advertising campaigns, meaning media buying on the platform's own ad system. And creator partnerships, meaning brokering sponsorships with other established channels. Most agencies market all three. Meaningfully fewer are genuinely strong at all three, which is worth asking about directly rather than assuming from a polished sales page. Some agencies charge flat retainers regardless of results. Others work on commission, taking a percentage of whatever revenue the channel generates. That distinction matters more than almost anything else in this business, and we'll come back to exactly why. The hidden trap. The one this exact industry already lived through once, under a different name. A nearly identical business model boomed, then largely collapsed a decade ago. And the reasons why are still relevant today. Multi-channel networks aren't a cautionary tale from a different industry. They're this industry, a decade earlier, at a much larger scale. Between 2013 and 2016, MCNs exploded. Disney acquired Maker Studios for a deal reported between $675 million and $950 million. These companies aggregated thousands of individual channels, negotiated better advertising rates, and took a cut of the revenue in exchange. The economics were real. YouTube itself keeps roughly 45% of ad revenue generated on the platform. Of what's left, creators working with a network commonly kept around 70%, with the network taking the remaining share for the services and access it provided. For a while, that model worked. One creator, interviewed by a media trade publication, described getting money up front, guaranteed ad support, studio space, and someone to actually talk to when something went wrong. Something she said was otherwise nearly impossible to get directly from YouTube itself. Then it fell apart. Trade press covering the collapse pointed to networks scaling too fast on top of what one media analyst bluntly called an already questionable financial model. A specific trigger made things worse. In 2017, a major advertiser boycott, widely remembered as the adpocalypse, pushed Disney to start dropping creators from Maker Studios entirely. Disney eventually folded what remained into something called Disney Digital Network, effectively ending Maker's run as a real network. Machinima shut down in 2019. Defy Media collapsed in 2018, leaving creators unpaid. By the end of that decade, the term multi-channel network had, in the words of one industry publication, become a dirty word. YouTube had matured its own tools. The middlemen weren't solving a problem creators still had. And the transformation didn't stop a decade ago. It's still happening right now. One of the larger surviving networks, BBTV, has since rebranded entirely to and pivoted toward AI licensing instead of traditional channel management. Studio 71, one of the more recognizable names left standing, was itself acquired by another company as recently as April of this year. The lesson isn't that every version of this business is destined to collapse. Some MCN successors are still operating today, transformed into more specialized talent and brand partnership companies. The lesson is narrower and more useful. This exact structure, aggregating creators and taking a cut of their success, has already gone through one full boom and bust cycle, and the failure mode when it breaks is specific. It's not that nobody makes money. It's that the model scales past what it can actually deliver, and the creators depending on it are the ones left exposed. The newer version of this business carries its own specific version of that same risk, and it has a name: survivorship bias. One person's channel actually blows up, or a handful of early clients see real growth. That success gets marketed as a repeatable system, a proven formula, a done-for-you playbook. What rarely gets marketed with the same confidence is the win rate. How many clients who bought the exact same service saw nothing close to that result? That's not a hypothetical concern. It's already regulated territory, more than most people realize. Making earnings claims without a reasonable basis is already illegal under existing federal law, specifically Section 5 of the FTC Act and the FTC's Business Opportunity Rule. Sellers of business opportunities are required to have real substantiation for any income claim they make, and to provide it if asked. This isn't abstract regulation sitting unused on a shelf. In one enforcement action, the FTC alleged that a company selling managed business services, in that case built around Amazon storefronts rather than YouTube channels, made unsupported claims about the profits customers could expect, in some cases through testimonials the agency itself allegedly presented as typical results when they weren't. More recently, in April of 2026, the FTC announced a proposed order against a top-earning participant in an unrelated multi-level marketing program over allegations of using social media and video specifically to promote earnings claims regulators said weren't substantiated. Legal analysts covering that case were explicit that its reasoning applies directly to affiliate networks, influencer-run teams, and side hustle programs generally, not just the original MLM context it came from. The FTC has also proposed, though not yet finalized, expanding the business opportunity rule to explicitly cover business coaching opportunities, which would close a gap that currently lets some done-for-you services operate outside the rule's clearest language. Worth knowing that proposal status can change, and it's worth checking current before treating it as settled. Put plainly, promising someone a specific income outcome from a channel-building service without real substantiation behind that promise isn't just a marketing risk. In the exact adjacent industry of managed online business services, it's already been the subject of a real federal enforcement action. The real engine, the one that actually separates a business built to last from one built to close its first cohort of clients, it isn't the strategy, the editing, or even the results. It's how the agency gets paid. So where's the line between a legitimate version of this business and a predatory one? It starts with the payment structure itself. A flat retainer gets paid whether the channel grows or not. That's not automatically a red flag. Plenty of legitimate work is billed that way. But it does mean the agency's income is disconnected from the client's actual outcome. A commission or revenue share structure ties the agency's income directly to the channel's performance. If the channel doesn't earn, neither does the agency. That alignment is one of the clearest, most concrete signals of a legitimately structured relationship, because the incentives on both sides of the table point the same direction. One practical question cuts through a lot of the noise here. Who actually edits the videos? If an agency answers that they partner with outside editors, that's not automatically a problem, but it does mean the agency may be reselling production at a markup. That's fine when it's disclosed. It's a real issue when a client discovers it by accident. A related pattern shows up in paid advertising specifically. Some agencies mark up the client's actual ad spend by 30 to 50% without disclosing it, quietly billing more for media buying than what's being spent on the ads themselves. Legitimate operators tend to share a few concrete traits. Realistic timelines. Most credible sources put measurable results at 3 to 6 months minimum, not the overnight transformations some pitches imply. Transparent reporting. Real access to the actual numbers, not a curated summary. And a willingness to show substantiation for any specific outcome they claim, the same substantiation the law already requires of anyone making a formal earnings claim. Predatory operators tend to share the opposite pattern. Large upfront fees with no performance component at all. Guaranteed results language dressed up in softer words. Case studies that are impossible to verify, built around a single standout client rather than an honest average. None of this requires assuming bad faith on every operator's part. Plenty of people running these agencies genuinely believe in what they're selling, in part because their own experience, or their best client's experience, really was that good. That's exactly how survivorship bias works. It doesn't require anyone to lie. It just requires nobody to look closely at the denominator. The real money in this business, on the agency side, comes from volume. Enough clients paying enough retainers that the ones who don't see results get absorbed into the average instead of standing out. The real protection, on the client side, is the same thing that protects you in any of these videos. Asking for the actual substantiation behind any specific number before you sign anything. Let's go back to Khaby Lame, because his full story captures both ends of this at once, and the most current chapter of it is still unfolding as this video is being made. First, the part that's simple and well documented. Lame lost a factory job in Italy in 2020 during COVID lockdowns and started posting silent reaction videos mocking overcomplicated life hack content. He went viral organically. The representation deal, with CGN Management, came after he was already one of the most followed creators in the world, structured around negotiating brand partnerships rather than manufacturing his initial audience. Using some of that success, Lame and his manager built Iron Corporation, an agency that today supports 235 other creators with 28 managers. That's the legitimate version of business within a business, built on top of a real, organic success story, not sold as a shortcut to one. Now, the more complicated, more current part. In January of 2026, according to a public SEC filing, Lame's operating company, Step Distinctive Limited, entered an all-stock transaction with a Hong Kong-based, NASDAQ-listed company called Rich Sparkle Holdings, valued at approximately $975 million. It's worth being precise about what that number actually means. This wasn't a cash payout. Lame became a shareholder in Rich Sparkle, with his eventual wealth from the deal depending entirely on how that company performs, not on money handed over up front. And how that company performed in the days immediately following the announcement is exactly the part worth sitting with. Before this deal, Rich Sparkle was, according to its own SEC disclosures, a micro-cap company with under $6 million in prior year revenue, in the business of printing financial documents. After the announcement, its stock price rose more than 650%, briefly valuing the company at over $16 billion, with Lame's own stake theoretically worth $6.6 billion. Within days, the stock had fallen as much as 77% from that peak. Financial reporting on the deal, including Forbes, quoted securities law experts describing the pattern: a company disclosing one line of business, then rapidly pivoting into an entirely different one paired with a dramatic stock swing, as a genuine red flag. One report noted an auditor resigned from the company shortly after. Another noted the SEC has been examining due diligence challenges specifically around foreign-listed issuers like this one. To be clear about what we do and don't know, this is not a claim that Khaby Lame did anything improper. Reporting on the deal notes he only commented briefly, well after the announcement, and that neither he nor the company responded to requests for further comment. What's actually documented is the structure of the deal itself and the specific, sourced concerns financial experts have raised about the company on the other side of it. That's the real lesson this story offers, arguably more useful than a clean success story would have been. Even the most legitimate, most organically built version of creator becomes business can end up standing next to a deal structure that experts are actively questioning. If the scrutiny required to tell the difference is real even at this scale, at 160 million followers and a management team with years of experience, it's certainly real at the scale of a client paying a few $1,000s a month to someone with a laptop and a strong pitch. So let's run the two real outcomes from the perspective of someone starting one of these agencies, not the client hiring one. The legitimate case. You built genuine expertise, either from your own channel or years of freelance editing, and you structure new client relationships around commission or revenue share rather than a large flat fee. You keep your client roster small enough to deliver real attention to each one. You're transparent about realistic timelines, and you can show real substantiation, not cherry-picked screenshots, for any specific outcome you reference in your marketing. Income in this version tends to be modest at first, often not fundamentally different from a skilled freelancer's income, but it compounds as your reputation and your client results become the actual marketing, rather than a paid ad campaign making promises your delivery has to catch up to. The predatory case. You had one early client who blew up, and you build an entire sales funnel around that single result, charging a large, mostly non-refundable upfront fee, regardless of whether any given client's channel ever performs. You take on far more clients than you can realistically serve well, because the retainer, not the result, is what pays you. Some clients do fine, many don't. The ones who don't rarely go public about it, because admitting the investment didn't pay off is its own kind of embarrassing, which quietly protects the agency's reputation regardless of the real average outcome. This version can run profitably for a while, sometimes for years, right up until enough dissatisfied clients compare notes, or until it draws the kind of regulatory attention we just walked through. Same industry, same pitch, same starting capital of basically nothing. The entire gap between those two outcomes comes down to how the agency gets paid, and whether its own success depends on the client's success or just on the client signing up. So is it worth it? If you're picturing a business that scales instantly because the barrier to entry is basically zero, that part is genuinely true, and it's exactly why this space fills up with operators who never should have started one. What's also true is that real expertise in growing YouTube channels is genuinely valuable, and there's nothing wrong with charging for it. The version of this business that lasts is built the same way the legitimate version of every other business on this channel is built, on real substantiation, aligned incentives, and a willingness to be transparent about outcomes that aren't always a straight line up. For someone with real, demonstrated skill, willing to structure client relationships around shared risk rather than guaranteed upfront income, this can be a legitimate, durable business, built on the same faceless, low-overhead playbook this entire channel runs on. For someone chasing this because one video went viral once, and treating that as a system rather than a single data point, the FTC has already shown it's paying attention to exactly this pattern in adjacent industries right now. Last reminder. This video describes business models and documented public patterns, not any specific company you might be considering. It is not legal or financial advice. If you're evaluating a real agency or considering starting one, that due diligence and that decision is entirely yours to make. Remember this, the agency isn't selling channel growth. It's selling belief in someone else's story. The legitimate operators earn that belief with real substantiation and shared risk. Everyone else is just hoping you don't ask to see the denominator.